Hi there, I'm Josip Matanovic. I'm a director here at Business Advisory, and today we'll be discussing the current lending environment and tips on how to improve our lending applications with our Lending Solutions Director, Phil Ringuet. We'll be covering the wash-up of the Royal Commission, current lending environment, steps to improve your application, and how to access good advice and what you should expect. So Phil, let's get started. In the wake of the Royal Commission, in your view, what has been the impact on prospective borrowers?
Yeah, good question, Yo. So, look, I think the real big issue here was less about clients' actual ability to borrow, and the wash-up from the Royal Commission really detailed in particular the way in which advice is actually delivered, and in particular, its transparency as well. But if we think of lending policy itself, the things that have changed actually changed over a period of time, and they related to things like living expenses, serviceability buffers, credit cards, debt to income ratios, and perhaps our best interest duty as a lender going forward. So just to give you a quick snapshot on the ones that I think are most relevant around there is likely to be living expenses. And that's the one that we've heard the most amount of noise about. So that's where the banks are really expecting you as a borrower to be ready, understand your budget in full, and be able to really talk to what is your actual living expenses versus your discretionary living expenses. Now, whilst it's not entirely black and white, it is pretty close to that point. So we need to be able to really have a good look at what they are and mitigate what living expenses should potentially be carved out because they could be actually lumpy or seasonal at that point in time. Another key one is probably around debt to income ratios. Now, this is an older policy that's really crept back into the lending space. And what that does is it actually puts a cap on the amount of debt you can have in relation to your income. Now, during the GFC, we saw these creep out to ratios of up to 10 times. This has come back substantially. A good number for debt to income ratio is around that 4 times, with most banks saying that they wouldn't want to participate in the loan application at the 5 to 6 times mark. But it's important to take into account which banks are actually out there because all of them have differing policies. The one that I think will have the most impact, though, around serviceability is probably around credit cards. Now, in the past, we used to take about 25% of the limit. That crept steadily up to 35%, and now we're looking at 45.5% of your actual credit limit with some lenders. Now, the regulators have even said on top of that, that what they'll actually look for over a period of the next year is for you to not only demonstrate that you can meet that interest bill based on your limit, but you can actually amortise that credit card liability in full within a 3-year period. Now, that's going to have a really big effect on borrowers, so it's important that we take into account those liabilities and perhaps restructure them where appropriate as well.
Correct, and looking at limits out there and whether they can be revised downwards.
Absolutely, it's a big part of what we do now.
Cool. So, next question. The latest research from the Digital Finance and Analytics reported that 48% of all home loan applications were rejected in November 2018. Why do you think it was so high?
Yeah, look, it's a really big number, isn't it? And look, whilst there's not one particular thing that probably drove declines or loan application withdrawals to that type of level, I think if I was to have a look at the range of applications we've taken, and it's probably got to be down to the client's actual preparedness to borrow as well. It's really important for clients to actually reflect on what their current position looks like today, and in particular, getting a really great understanding of their actual credit history and the reporting itself. Now, what we're looking for at this point is what the actual score is itself, perhaps how many applications for credit they've made over a period of time, and even which lenders they've actually applied with. So it's important to address those points. Spending history is also really key. Whilst a lot of our clients and clients that we hear within the marketplace think that they've got a pretty strong handle on their budget, whilst running a budget is one thing, to actually maintain that is entirely another. So really setting some realistic expectations that can actually be met will certainly help that application as well. Conduct, of course, is key. The banks are taking a really deep dive into our clients' statements with positive credit reporting and then also sharing credit reporting across various banking platforms. It's important that these are taken into consideration. Other basic items come down to the client's actual age, what's their retirement strategy or the exit strategy for the transaction, and even the value of their property. So I guess the one thing, whilst there's a number of different items in there, is the clients really need to be prepared, and perhaps with better preparation over a period of time, they'd have a lot more success and we'd significantly reduce that 48% decline rating to something that's much more reasonable as well.
Correct. Perfect. Good points. Now, as a borrower, what steps should I take or consider prior to my making my application?
Cool. So look, like I said, really comes down to that being prepared, Mark. We like to have conversations with our borrowers up to 6 months out from when their application's due. Now, by doing that, we actually get to have a really great snapshot of what their current circumstances is, and we can actually make recommendations to improve the probability of a great credit outcome as well. So things again, understand your credit profile, reduce or reorganise any debts will also be key. Create a budget and really stick to it. But most importantly, it comes down to good advice. So have a great team that works behind you, someone who understands what your tax objectives are, your investment objectives are, and helps to align those with what you're actually trying to achieve over the course of the next year to assist with your borrowing ability.
Phil, are there any additional considerations for business applicants?
As a business applicant, it's really important to be able to really clearly articulate exactly what your business plan is, who your market is, and what your strategy is going forward as well. Also, having a deep understanding of your current cash flow in relation to both your profit and loss and your balance sheet is also going to help to build a very sound credit application. We really work hard with our clients within business advisory as they're able to access three-way forecasts, which you well know, and these certainly substantiate and support our credit applications as well. So getting great advice, I really can't understate how important that is. Making sure that the advice you have is relevant to what it is you're actually trying to achieve over the short to medium term. A really great example of this is sometimes our clients, whilst trying to save a little bit on tax, that doesn't necessarily translate to additional income and can really adversely affect our clients' ability to borrow. The other part of this is really understanding your business and how it's actually valued. Now, there's hard and there's soft factors that determine the valuation of a business. Some of the hard factors that a bank might consider is your financial statements, your tax returns, and your forecasts. Now, these are all really great, important pieces of information, but it's just as relevant to be able to articulate who your key staff are, your clients. Are they actually well diversified, and that there's no concentration in income? In terms of your discipline as well, does that cover a number of geographies and even disciplines at the same time? These are some of the things that can really help to build the value of your business and really bulletproof your credit application going forward as well.
I agree, Phil. There are a lot of items to take in. What services does VLS offer, and how can VLS play a part in all of this?
Yep. Well, as you know, VLS, or Vincents Lending Solutions, is a full service brokering business. So we're able to add value in every aspect of our clients' borrowing requirements, whether it be for a home or investment loan, whether it be for a commercial property or a business acquisition, or even equipment finance as well. So our consultants are really able to have a deep dive into the actual transaction itself. They can conduct an initial interview, which doesn't put you anywhere near a bank's decisioning process as well. So you can start to build that transaction at the very beginning. A few of the offerings that we've also created, which are particularly useful in this environment, is the services we offer around budgeting and cash flow. We all know how difficult it is to actually bring in your bank statements and all of your financials into one place. We've got tools which allow us to effectively and efficiently bring those together and provide our clients feedback and analysis on what their actual budgets are, their expenses, and their cash flow to create a better credit submission. Another couple of interesting things that we offer is around credit writing support. So this could be in relation to annual reviews or credit writing proposals, but also debt advisory, which I'd like to touch on very briefly. So for some of our bigger commercial and corporate clients, it's not as easy as picking up and moving banks, but it's really important to know that you actually have the best deal in the current environment. So under our debt advisory arm, we're really able to pop the hood and have a look at what's underneath to make sure that everything's in line with your expectations and you are actually getting the best possible deal in the marketplace. Now, things that we take into consideration are, what's the structure of the debt? Does the security align? What about the covenants as well? Do they make sense? But more importantly, what's the pricing? From an account and a daily perspective through to the actual pricing of facilities, and is it relevant? So we can help our clients by providing a scorecard where we act on either behalf of them and address the banks directly, or arm them with the information so they can have a better and more informed conversation with their current banker as well. So we've had a bit of take up with that, and we think that's working pretty well in this environment too.
It definitely has. Well, thanks, Phil, for today. We got some great insights into, I guess, the current lending environment post the Royal Commission. If any of our clients want to engage Phil in our VLS services, please don't be afraid to contact in the details following.